This is a RUT EIP case study. This is a trade from late last year. So before I put this trade on, right, I kind of want to get an idea of what's happening out there. Am I getting in this trade in the hall? Am I getting into this trade after a massive rally? And kind of use my very basic technical analysis of what I think is going to happen. You know, and the key for a trade like this is not what I think is going to happen. It's more about what am I going to do if something happens, right? So I always talk about we have to have a plan. The plan is what's going to define the trade. If you have a good plan, if you stick to your plan, your trade is going to either work the way it's supposed to, and if it's not going to work, you're not going to be exposed to blowing up your account. So trade plan is number one. Always have to have a plan, and the second most important thing is that you have to actually stick to it. So here we have RUT. This is December 15th, right? We have a big move to the upside. This was I believe this was after the election. We saw market just completely take off, and after a big move higher with a very few shallow pullbacks, I thought that, well, this market is, you know, looking to make a run to test all-time highs. There's definitely been a lot of money put to work here. I don't see the market just completely collapsing on itself unless there's some news there coming out of Washington and whatnot. But so my outlook for this for the near term was definitely bullish. So I thought this was a good idea to put a trade on. So let's talk about the plan. I mean, the details of this plan laid out in the trade guideline. And if anybody does not know where to get it, it's on the website. Let me know and I'll point you in the right direction. But just looking at the guideline, right? So the plan of this trade is I'm looking to scale into tier 2 and tier 3 as RUT is trading higher. My add points are when price trades above upper long put. I'm also looking to scale out when price is 30 points below short strike of the highest tier. And this trade works best if RUT runs up in the first 30 to 40 days and then reverts back towards the body of the butterfly. That is how this trade works. So we need to assume that we're going to see higher prices, and then potentially the price is going to revert back to the mean in hopefully the last 2 to 3 weeks of this trade, and that's where the profit comes in. And the first 30 to 40 days gives us an opportunity. As the underlying is running higher, we'll get a chance to add tier 2 and tier 3, and those add points is when price trades above upper long put of our butterflies. I hope we are clear so far. So this was the entry, right? RUT is trading at about 1366. I went out and I looked for options that were about 15 points below market, and I bought a wing 50 points lower and I bought a wing 30 points higher. 64 days to expiration. Price was at 1366. We sold 1350 and I bought wings at 1300 and 1380. Very simple. So according to the plan, if we're going to add, we have to add here when the price is above our long put on the upside, the 1380. And if we're trading 30 points below 1350, which is our short strike, that's where I'm going to look to take off this butterfly and roll it down to closest to at the money. So that was my initial trade plan for this. Now in hindsight, RUT traded sideways for the next 40 days. Nothing happens. I did not get an opportunity to scale into this trade, and that's totally fine. We're actually going to go step by step and look at this trade at different durations, right? So again, if you aren't familiar with a trade like this is a very boring trade. There's only very few points where something needs to be done. Either we're adding as the price moves higher, or we're defending it if the price is moving lower. There's nothing else to do in between, so it's a very boring, very slow trade, but it's very, very powerful, and it's very, very flexible. So here we're going to look at this trade at different time points. So we have T plus 7, 1 week in, nothing happened, small profit, nothing going on. Another week goes by, we're at T plus 14. Again, we're still underneath that upper long put, so nothing to add on the upside. We're not 30 points below our short strike. Nothing to do here. Going forward, now we're at T plus 21. We're 3 weeks in. We saw the price go above our long put on the upside. However, towards the end of the day, the price dipped right back below. Right? So for me, at least, that's what I look at. If the price can't close above that upper long put, that's not a confirmation to add. So I wait maybe the next day. So if we see price open above and close above the upper long put, that tells me that it's time to add tier 2. This wasn't the case here, so we couldn't close above the upper long put, no add. Another week goes by, we're at T plus 28. This trade is showing a decent profit. Again, we are still below our upper long put, and there's nothing to do to this. All right, we're at T plus 35, and the price is kind of moving away or towards our short strikes here. Right, my downside adjustment is somewhere here with 30 points below my short strike. It's time to wake up and do something. If not, there's nothing else to do until we're above the upper put on the upside. So at T plus 41, right, so this trade has been on for 41 days, and the profit target has been hit, and the price is now trading into the end of the day. Russell is closing near or at the high of the day, which is I guess a bullish sign, assuming we see some follow through the next day, and that also signals an add point. So now there are 23 days left in this trade, and this is why I brought this up. This is kind of similar to the EIP trade that we have on right now. So with 23 days to go, right, is it the best to start adding tier 2 and tier 3 the way that the guideline says we should? Or is there anything else that could be done in order to manage this trade? So the first thing, number one, is that after 41 days of sideways, the profit target has been hit. So it's, for anybody that's new or not as experienced with this kind of trade, the path of least resistance is to take this trade on and move on, right? But let's see what else can be done here. So we have 23 days. The reason why I don't think that it's a great idea to start to add tier 2 and tier 3, because remember, as I said earlier, the way this trade is going to work out is that we have to let the price go, and then as it goes, we're adding tier 2 and tier 3. But the way this trade is going to make money is we need to see the price come back in, right? The price needs to come back in towards these profit tents that we're building out. And with only 23 days to go, now remember, these are 23 calendar days. 23 calendar days are about 15 trading days. Sometimes it's just not enough time to let the price go and then come back down. And by adding tier 2 and tier 3, we're not only adding downside risk, we're also adding upside risk. And if the price just goes and stays there for the next 3 weeks, right, there's no reversion back towards the profit tent, this trade is going to be a loser. It's going to be a small loser, but it's going to be a loser. And the profit target for this trade, so again, going back to the trade guideline, right? Tier 1 has a profit target of about, assuming it's only one contract, about 400. We could also use, and I think this is probably maybe a better metric to use, about 15% return on risk. Okay? Tier 2 will be at about 800, and fully scaled to tier 3 profit target is about 1200 per one contract. Okay, so this trade was a 2 contract, so this is a 2 lot. Profit target was about $800, and at T plus 41 this trade was showing a unrealized P&L of about 905, assuming that the price to close was going to be real. But you know, just so we understand that, you know, when we get into that neighborhood of where we're hitting our profit target, it's a good idea to put orders out there to see if we can get a fill to close out near, as close to the profit target as possible. All right, so with 23 days, as I said, I didn't feel that this was a good idea, or maybe that I had enough time to let the price run away and then potentially come back towards the body of this butterfly. So what else can we do here? Well, we could also look at the chart of the rut, right? So 40 plus days of just pure sideways action, garbage, nothing, right? And now it looks like if we could just take out some of these previous highs, we could trade higher. Now, you know, is that what's going to happen? I have no idea, right? But if we do, I definitely want to participate on the upside and find a way to maximize my profit, if possible, on the upside. And I'm always aware that if, you know, if we see a fake breakout and if I do something and we see price go the other way, I know where my risk on the downside is, and I'm always prepared to defend that level. All right, so here, based on the assumption that we're going to see higher price, what I decided to do, instead of adding tier 2, I decided to roll my upper put on the upside down. Roll it down 10 points. This is similar to what we just did with the current EIP that we have on. Right, so rolling down this put is going to maximize maximize reward on the upside, but it's going to increase a little bit of risk on the downside. And it's also going to add more positive delta to this trade, right? So delta will go from negative to positive. Okay, and this is what the P&L graph looks like. Now we can go back and see, right? So here we have our max reward is right here. And now we have more reward on the upside and a little more downside risk. It also takes our net delta to positive, but the risk here is that our T plus 0 line is kind of steep on the downside, so we have to be aware of that. Now, after making this adjustment, obviously I know that my only risk is on the downside, and that's what, you know, while it's nice to have a potential upside here and no risk on the upside, the downside risk is what I'm always concerned about. And I know that if I see the price start to go the other way, I'm going to need to be quick to make whatever adjustments. Maybe it's rolling this put higher, which is going to take my right side of this P&L graph lower, and it's going to raise my T+0 line higher and just smooth it out a little bit. Okay, so and at the same time, I also know that, you know, if we are going to see price trade higher, I'm totally cool with that. And if we're going to see price come back towards the short strike here, that's also going to benefit, as long as we don't go too far under the short strike. This trade is going to be fine. So, as always, or most of the time, my guess that we're going to see higher price was wrong, and RUT started to move lower. Now, to reduce downside risk, long puts on the downside can be rolled higher towards the short strike, right? Same thing we were doing is we were rolling our upper puts to lift the right side of this graph. By rolling downside puts, that's going to lift the left side of this graph, and it's going to push the right side lower, and that's going to raise our T+0 line and make it a little more smooth on the downside. All right, so this is what this looked like before these puts were rolled. So now the T+0 line, we can see it's pretty steep here. It's not as steep, but the risk is still on the downside. Always have to be aware of that. All right. Now, 55 days in this trade. There are 9 days left. So two things. Number one, anyone that's fairly new, maybe not as experienced, should not be in the trade that's this close to expiration. Anybody want to guess why? Gamma. Gamma is the reason why we don't want to trade this close to expiration, right? Because the curvature of our T+0 line is going to really start to kick in as the days run out, and we don't want to be riding on either end of this curve. So that's why I say that anyone that's a little more advanced or experienced in trades like this, or just, you know, complex trades in general, and knows how to manage the Greeks, is what really the important part here, right? So like we could understand where the risk is. So anyone that's a little more advanced could stay a little bit longer and maybe see if we could milk out a little more theta out of this trade. Again, the goal is to balance and to manage our net delta while we're waiting for theta to really come in. But new traders should try to avoid being in this trade with 9 days to go. Okay? So RUT is inside of the profit tent here, and the price indicates that we may see more upside. Again, I was a little bit wrong before, and now, you know, we saw RUT trade down, and then closing near the highs of the day kind of told me that we may see some more upside follow through. So if I am expecting more follow through to the upside, the best way to add more positive delta would be to roll my long puts on the upside down towards my short strikes, and that's going to, again, increase my potential payout. It's going to also increase my potential downside risk. Okay, so rolling down these puts by just 5 points from 1370 to 1365, right, we can see that my potential payout on the upside has increased, but the steepness of the T+0 line on the downside has also increased. So I'm taking on more downside risk, right? That's my risk, and that's my reward. All right, moving on. Next, 2 more days go by. 57 days in this trade. There are 7 days left. Again, new traders don't want to be in this trade with 7 days to go. So we did see some follow through to the upside. Now the price is outside of this tent once again. Two things. One, this trade could be just left alone and there's nothing else that needs to be done to it. However, sometimes I just like to do things just because, I guess. But it made sense to take on, and the price action was bullish, and I kind of thought that we're going to see more upside here. And again, to maximize my potential profit even more to the upside, right? I wanted to raise my payoff graph on the right side here a little bit higher. Once again, the way to do it is to roll my long puts on the upside down towards the short strike. So rolling these puts from 1365 down to 1355 has increased my potential upside, and it also increased my downside risk, which is right here. Now, 62 days in, 2 days left until expiration, and this trade is almost at its maxed potential profit. Can't make any more than what this line, right? This line here cuts us off and tells us how much is the most we could possibly make here. 2 days to go. This trade is almost at its maxed potential. Now, because all options that are part of this trade are out of the money, right? We have a put here that we're long, that's out of the money. We're short puts here that are out of the money, and we're long puts here that are out of the money. So all options are out of the money. This trade can be left alone and held through expiration, right? What happens if all of these options, long and short, are out of the money? They expire worthless. They expire at zero. So this trade could be held through expiration and left alone. However, even the most advanced traders can't possibly fix this trade if, for whatever reason, RUT settles under 1310. Now, we just think about this. Price is at 1403. Now we're talking about downside risk down to 1310, so 100 points in 2 days. Can it happen? I suppose. Sure. It's very unlikely that we're going to see that, but if we do, right, the remaining what's left, I mean, the potential profit here that's left is, I don't know, probably less than 50 bucks or something. The remaining potential profit here is not worth all of this risk. Is for whatever reason, right? For whatever reason, RUD goes down 100 handles in 2 days. This trade is going to be a loser to the tune of about 5 grand. So is 50 bucks that's left worth, right? We have maybe $50 left here. Is it worth the $5,000 of risk with 2 days? Anyone? Yeah, I don't think so. So the best way to avoid putting yourself in that kind of trade, these 1350 puts are at about 25 cents. Now there are 4 of them. Taking these off, buying to close, 4 puts for 25 bucks each. So I'll pay $100 to get out of this trade and walk away with about $1,600 profit. So the takeaway for this trade is that I didn't get a chance to scale into tier 2 and tier 3 and do all that fancy stuff, and that's totally fine. Even though the price did go above my original long put on the upside, instead of piling more butterflies on top of my tier 1, I found a way to maneuver my long upper puts right? I moved them down towards the short strike, and then the price started to go down. I started to move my long puts on the downside, right? I started to pinch in this trade a little bit and found the way to keep my original tier 1 on and try to milk this trade as much as I possibly can. And while doing it, I had no upside risk, and all the risk was on the downside. I know you guys probably have questions about this, and I want to get to it. But I also want to do is I want to hop over to my OptionNet Explorer and take a look at the current EIP with 23 days left and kind of show you how this ties in to the trade that we have on right now. So this is the EIP trade that we have on right now, 37 days in with 23 days to go. Now we can look at the price, and the price is, no, we were actually trading at a new all-time high earlier today. So I don't know where we go next, but I would assume that if we can clear and stay above these levels here where we found sellers before, if we can clear the sellers at these levels, we can probably trade higher. So my short-term overall outlook is bullish, and just because I said it, we're probably going to see Russell trade down 60 handles in the next 2 weeks. But if we don't, right, let's look at the P&L graph. Where's the risk here? If we see those sellers go away at all-time highs and Russell takes off and goes to 2,000, we have no risk on the upside. I don't know about you, but I'm totally cool with that. All of the risk in this trade is to the downside. So if we are going to see Russell trade to the upside, this is the most we can make. Now, can we do something to take this line here, right? That's our max potential profit line. Can we take this line higher? Yeah, that's exactly what we did before. I mean, in that example I showed you, right? Rolling these puts closer, right? Rolling these puts closer is going to raise my max potential profit line to the upside, but it's going to push my downside risk down a little bit, and it's going to make my T+0 line a little steeper. So if I'm willing to accept this new risk to the downside in exchange for potential increased reward on the upside, then that makes sense. All right, so before we wrap this up, let's just take a look. So we got 23 days to go, and this is what this trade would look like if we roll our 1490s down to 1480. Right, the green line represents the new adjusted P&L. The blue line is the current P&L at expiration. So rolling down these puts 10 points is going to increase our upside potential. It's going to increase our downside risk, and the T+0 line will go from this to this. Right, and we could also see this in the Greeks. Delta goes from +2 to almost +8. Theta is going to go up, and so will gamma. Right, gamma tells us about the steepness of our T+0 line. The higher the gamma, the more steep our T+0 line is. So just something to think about. This isn't, this isn't to tell you that go ahead, we got to go and do something right now. Just something to think about. If we're willing to accept more downside risk for potentially a little bit higher upside reward, then an adjustment like this makes sense. If not, it's totally okay to hold this trade the way it is, let time run out, and worst case scenario, Russell is going to expire somewhere here. And this trade is going to make money. Again, our downside risk is on. We need to be prepared to defend this, and again, the levels that I'm watching for this current trade are 1500 and 1480. All right, I hope this helps, guys. If you have any questions, please let me know. You can email them to me. You can also use the form that we have in the chat. We're going to address a couple of other questions that we had from our members.